Good morning. Thank you for joining today's Benefits and Compensation University webinar. Our program today will focus on developments and key issues for qualified plans in 2020. My name is Maureen Gorman, and I'm happy to introduce today's panel. I'm an employee benefits partner in Mayor Brown's Palo Alto office. Joining me today are my colleagues, also in the employment and benefits practice, Counsels Rebecca Davenport and Ceci Ross, and Associate Hillary August, all located in the Chicago office. I'll cover a few administrative matters and then we'll get started. First, at the bottom of your screen, you'll notice that there are multiple application widgets you can use, including the Q&A widget for those of you with questions. Answers to some common technical issues are located in the Help widget on the right. For the best viewing experience, we recommend using a wired internet connection, preferably with Chrome or Firefox browsers, and closing any programs or browser sessions running in the background that could cause issues. Some networks cause slides to advance more slowly than others, so logging off of your VPN or Citrix connection is recommended. If you are applying for CLE credit, you will need to record the alphanumeric codes provided during the program on the affirmation form found in the Resource List widget. There will be two codes provided today, one halfway through the platform and the second at the end. Also in the Resource List widget, you'll find a PDF of today's slide deck and a link to speaker bios. This webinar is being recorded, as we normally do with these programs. In a day or so, we'll be sending you an email with a link, which you can use to listen to the webinar again or share with your colleagues. The recording will also be posted on our website. Finally, we hope to allow time at the end of the program for questions. To submit a question electronically, please use the Q&A widget. If we don't get to your question during this webinar, we'll make every attempt to follow up with you afterwards. I'll just quickly mention my apologies. You won't be able to see me today because of a technical glitch. You'll only hear me, but you should be able to see each of my colleagues on the panel. So with that, I'm pleased to introduce my colleague, Rebecca Davenport.
Thank you, Maureen. Hello, everyone. Today, unfortunately, in the current environment, there has been a need for many employees to dip into their retirement savings just to get by. And there have been quite a few recent new developments in the area of qualified plan distributions. So today we're going to start the presentation with a focus on those. I'm going to discuss some issues relating to hardship withdrawal. Hardship withdrawals, give a high-level overview of various other recent updates in the area of qualified plan distributions, and refresh on certain aspects of coronavirus relief. And I'll turn it over to Ceci, who will continue the discussion of distribution topics with required minimum distribution updates before moving on to updates relating to safe harbor 401k plans. As noted, I'm going to kick off the discussion of distribution issues today with a topic that's somewhat old news, but still worth talking about a couple of issues. As probably most of you know, the IRS issued final hardship regulations in September of 2019. Together, those final regulations with the recent legislation that's reflected in the regulations have made certain mandatory changes to how plans administer hardship withdrawals, and also allowed plan sponsors to make other discretionary changes. Those changes are summarized here briefly in the slides for you. Optional changes could be made effective as early as 2019, and the mandatory changes had to be put in effect for this year. There are a couple of issues related to hardship withdrawals that are worth noting, especially in light of the fact that many plans likely still need to be amended to align with plan administration due to an extended remedial amendment period. As a reminder, the final regulations do appear on the IRS's 2019 required amendments list, and under current IRS guidance, the deadline for adopting amendments to reflect all changes related to the final regulations is December 31st, 2021. The first issue we want to discuss is the need to understand from plan administrators how hardship withdrawal needs are being substantiated. This can be important for plan administrators to understand and to be prepared in the event of a future IRS audit. As background, withdrawal from a 401k plan for hardship is permitted only when the withdrawal is on account of an immediate and heavy financial need and is necessary to satisfy that need. IRS regulations provide guidance for ensuring that the withdrawal satisfies those requirements, including providing specified safe harbor events that many plans use for determining whether a distribution is on account of an immediate and heavy financial need. The IRS has been focused in recent years on how plan administrators are able to ensure that the immediate and heavy financial need requirements are satisfied. Guidance was issued in 2017 in the form of a memorandum by the IRS to its agents performing qualified plan audits, which guidance has since been incorporated into the Internal Revenue Manual. The IRM outlines examination steps to be taken by an IRS agent conducting a 401k plan audit, including substantiating the basis for a hardship withdrawal to determine whether it was proper. Substantiation may be made either by having the employee provide the actual source documents at the time of the withdrawal request, or by using a summary method, which requires that a summary of the information provided contained in the source documents. If the summary method is used, the plan administrator must provide certain notifications to the employee, including letting the employee know that in the future he or she may need to provide those actual source documents at any time upon the request of the employer or plan administrator. So it would be good to confirm which method your third-party administrator is using, and if it's the summary method, confirm that the required notification is provided to participants who take a hardship withdrawal. Even if proper procedures are followed and the required notice is given at the time of withdrawal, be aware that the IRS agent auditing a plan may later request those source documents because he or she concludes that the summary is inconsistent or incomplete on its face, or simply based on the fact that the employee has received more than 2 hardship withdrawals in a plan year. This can cause problems if the participant didn't retain those source documents and is unable to produce them as instructed that he or she may need to do, because failure to substantiate the validity of a hardship withdrawal to an IRS agent on audit could be considered a qualification failure for which sanctions can be imposed. It may also be worthwhile to look at the data as to what types of withdrawals the population is taking and with what frequency. As I mentioned, multiple withdrawals by a participant during a plan year can be a red flag. So in some cases, it may even be worth considering whether to limit hardship withdrawals to no more than 2 per year. The final regulations moved away from the old safe harbor method of substantiating that a withdrawal is necessary to satisfy a heavy, immediate and heavy financial need to a method that focuses on the employee's representation that he or she has insufficient cash or other liquid assets reasonably available to satisfy the need. Like with the old safe harbor, there still remains a requirement that participants obtain all other currently available distributions under the plan and all other deferred compensation plans maintained by the employer. The plan may choose now not to require that the participant obtain first any other available plan loans, which previously was a requirement, but it's still necessary to confirm that procedures are in place to ensure other available distributions are taken before hardship withdrawals are allowed. For example, distributions under non-qualified deferred compensation plans and cash dividends that might be available under an ESOP portion of a 401k plan might be examples of distributions that might be considered currently available. Also, keep in mind that if a plan has implemented the new or does implement the new optional qualified birth or adoption withdrawals that I'll talk about in a moment, that may potentially be another currently available distribution depending on the facts. Moving away now from hardship withdrawals and setting aside for the moment updates relating to coronavirus, let's move to an overview of various other recent developments and guidance relating to qualified plan distributions. We'll cover these mostly at a high level, mostly for awareness, but you should be aware they're out there and where to look for guidance in case questions do come up. A recurring topic distribution topic lately is disaster relief, of course. Obviously, there's been a lot of focus on the relief relating to coronavirus and the CARES Act, but the distribution rights and loan payment relief enacted this year is modeled after relief we've seen in the past. In fact, in recent years, there have been enough disasters and relief issued by the IRS and legislative relief to result in series of guidance for qualified plans that's somewhat daunting and complicated to keep track of. Revisiting the hardship regulations for just a moment, I want to mention that partly in an attempt to alleviate the need for ongoing disaster relief announcements, the final 401k hardship regulations do add a safe harbor distribution event for losses due to a disaster declared by FEMA. However, it's worth noting that the safe harbor withdrawal event is not as expansive as disaster relief that we've seen in the past. Also, legislative action is needed to allow participants a right to repay distributions taken and to give relief from the 10% early withdrawal penalty that otherwise applies. A good example of this is qualified disaster relief provided by the Further Consolidated Appropriations Act of 2020, the requirements of which are summarized for you in the slide. And this will look familiar to you as it's now been completely dwarfed by the similar relief provided under the CARES Act relating to coronavirus. But it's good to be aware that's out there. Overall, I think the important takeaway for disaster relief is to really look closely at the guidance and understand specifically what relief is available for each type of disaster and to see what you might need to do for plan amendments. And speaking of plan amendments, one trap for the unwary is that if you do have a plan that implemented those qualified disaster distributions, the plan does need to be amended to reflect that relief by the end of this year, even though most of the amendments we're talking about today have an extended deadline for adopting plan amendments. As I alluded to earlier, there's a new in-service distribution option enacted by the SECURE Act, which gives plan sponsors an option to allow qualified birth or adoption distributions, or what we've seen referred to as QBODs. We haven't seen too many plan sponsors yet implementing these types of distributions, as they are new for this year, and there have been a lot of questions about how they'll be administered. The IRS just in September published guidance answering some of the questions in the form of Notice 2020-68. However, it'd be interesting to see how widespread these offerings are, and some questions do still remain. Basically, a QBOD provides an opportunity to allow in-service distribution of up to $5,000 in connection with the birth or adoption of a participant's child without being subject to the 10% early distribution penalty. And unlike hardship withdrawals, these amounts are subject to a repayment right. They're eligible rollover distributions that may be repaid to the plan. The IRS guidance makes it clear that if this type of distribution is offered under the plan and the participant would otherwise be eligible to make a rollover contribution to the plan, then the participant must be allowed to roll in a prior QBOD. However, it isn't clear whether this repayment right continues indefinitely, and it also appears that the plan would need to track this as an after-tax contribution because there's no similar relief to coronavirus-related distributions that allow the participant to amend his or her taxes and reverse the income previously paid. QBOD seems to be modeled more after a qualified reservist distribution, which has been around for some time, except that for those, repayment is only allowed to an IRA and then only for a limited period of time. Most of the distribution topics we're covering today relate to 401k plans, but quickly want to mention that the bipartisan American Minors Act of 2019 modified the rules that apply to defined benefit pension plans to align with the 401k plan rules that allow in-service distribution beginning at age 59 and a half. This is a move away from the prior rules that tied the in-service distribution rights to the normal retirement age under a defined benefit plan. And it may be helpful because under those old rules, it was difficult to allow in-service distribution before age 62. And this could be a particularly useful design for a plan that, say, offers early payment with subsidy, for example, at age 60 with no reduction to avoid participants retiring early to take full advantage of that subsidy. However, it is an optional change, so plans do not have to be amended to reflect this if the plan sponsor doesn't want to. Another topic I want to mention in light of recent IRS proposed regulations is the qualified plan loan offset. Plan administrators need to understand the impact of an outstanding loan when an employee terminates and the impact of reducing a participant's account balance to offset an unpaid loan, because the plan must properly report whether a plan loan offset is qualified on Form 1099-R. The consequence of being qualified is that the former employee has an extended period of time to roll over the amount of the offset until the due date for filing his or her tax return for the year in which the offset occurs. There's a little more detail on this in the slides if you want to review that, and also, again, just be aware that there are proposed regulations now issued for those. Also related to distributions, we've had questions about relief in the context of spousal consent requirements in light of social distancing. Hopefully that's becoming less of an issue now, but if it does come up, know that the IRS issued temporary helpful relief from the physical presence requirement in the form of Notice 2020-42. Lifetime income continues to be a hot topic, and I wanted to mention that the SECURE Act provides a safe harbor for selecting an annuity provider, which can help protect plan sponsors who want to offer lifetime income options in a 401k plan. And also the SECURE Act enacted a new code section 401A38 that may be of interest if you have lifetime income investment options and for whatever reason need to eliminate those, for example, in the context of a plan merger or a change in record keeper. By the way, each one of the SECURE Act changes we're talking about today, for each one of those, it's good to be aware that the Act itself provided an extended amendment deadline that's generally December 31st, 2022 for a calendar year plan. So this deadline would apply to any optional changes implemented before that date, and after that, the discretionary amendment deadline would apply. Next, I'm going to touch on a couple of final miscellaneous distribution related updates. The SECURE Act prohibits loans being made through credit cards. I've never seen this in a plan, so I'm not sure that that'll be much of an issue. I want to mention it. Also, the IRS on October 1st published final regulations relating to the Jobs Act changes to Code Section 3405 for withholding on periodic pension and annuity payments made after December 31st of this year. Basically, the final regulations just align with the changes made by the Jobs Act to Section 3405 and generally provide that certain default rules will be set forth now in IRS guidance and publications rather than being in the statute or regulations. And so this new approach obviously gives the IRS much more flexibility to change the default from one year to the next or even more frequently. So plan administrators will need to be able to react quickly to any changes. The good news is for the time being that the IRS guidance uses the same defaults that were in effect before the Jobs Act changes. Moving now to coronavirus relief. Obviously, there was a whirlwind of activity that accompanied the passage of the CARES Act for plan sponsors deciding whether or not to implement the relief afforded by the Act for accessing retirement plan savings and trying to deal with open questions regarding the relief. The IRS did provide guidance in the form of Notice 2020-50, which was helpful. But the temporary provisions allowing access to retirement funds are now winding down as we head towards year end, with the window for taking a coronavirus loan now closed and coronavirus-related distributions, or CRDs, and loan suspension relief closing at the end of this year. So just briefly wanting to touch on those topics, and then Ceci will later discuss the required minimum distribution waiver that was part of the CARES Act. As with the SECURE Act changes, you should know that there is an extended deadline for adopting plan amendments to reflect coronavirus relief, which is also generally December 31st, 2022. And although it's fine to actually get the amendments adopted, and likely nobody's going to be wanting to really work on those or able to work on those in this busy fourth quarter, it would be good to start putting pen to paper early next year to know what changes were made in plan administration and flesh out the details while that's still fresh. Also, if you happen to work with a plan that's qualified both in the U.S. and Puerto Rico, just want to note my understanding is that it's necessary to amend for CRDs by the end of this year to comply with the Puerto Rico qualification rules. We anticipate the questions now will be coming up more along the lines of or dealing with the repayment of CRDs and reamortizing plan loans for payments to start up again in January. The IRS's expectation is that if a plan allows rollover contributions generally, then it will accept a rollover contribution that consists of a CRD. Notice 2020-50 also clarifies that plan administrators may rely on a participant's certification that he or she is a qualified individual, one of the requirements for a CRD, unless the plan administrator has actual knowledge to the contrary. And also keep in mind, as noted in the notice, that a plan sponsor can be protected under Code Section 401A31 regulations, as long as the plan administrator reasonably concludes that that the rollover contribution was valid, as long as the amount of the invalid contribution plus earnings is distributed after finding out that it was not in fact valid. Finally, recontribution of a CRD is treated as pre-tax, and the burden falls on the participant to amend his or her tax return to reverse the income previously reported. For plans that offer the optional CARES Act suspension of loan repayments, Notice 2020-50 provides safe harbor method for reamortizing those plan loans when payments resume in January. Recall that the term of the loan may be extended in that case for up to 1 year, so the maximum 5-year term would not apply, and that participants must repay the interest that accrued during the suspension. You'll want to check in with plan record keepers and memorialize administration in preparation for reflecting administration in those plan amendments, and of course we'll want to communicate new loan terms to affected participants. Finally, don't lose sight of the fact that there was separate loan relief provided under IRS Notice 2020-23, which allowed participants to delay certain loan payments between April and July of this year, but there was no ability to extend the loan repayment term for that relief. And I'm now going to turn it over to Ceci to continue the discussion of distribution issues.
Hello. I'm going to talk about required minimum distribution rules, and particularly the changes that were made by the Secure Act and the CARES Act. But because the rules are kind of complicated, and in order to understand the changes made by the Secure Act and the CARES Act, I'm going to give a little background about the required minimum distribution rules. And just so you know, I may end up referring to the required minimum distributions and the rules by RMDs, because when I talk about this, I find it's a bit of a tongue twister. Try saying required minimum distribution 3 times real fast, and you'll see why. Anyway, the main thing about the required minimum distribution rules is that there are deadlines for when payments must be made from plans. And by the way, I'm focusing on qualified plans. Some of these rules also apply to IRAs with slight differences, but I'm focusing on qualified plans, and in particular defined contribution plans, because the Secure Act and in particular the CARES Act, the changes apply only to defined contribution plans. But basically the rules are that there's deadlines for when payments must be made or begin to be paid to plan participants during their lifetime and after death, and that they're under 401A9 of the Internal Revenue Code. And even though they're deadlines, because they're deadlines, plans may require earlier payment. But in any case, if the plan fails to satisfy the required minimum distribution rules, it risks potential plan disqualification, and also there are excise taxes on participants if they don't get their RMDs on time. So during a participant's lifetime, and this is a rule that you're probably all quite familiar with, a participant must begin to receive their required minimum distributions by the required beginning date. And the required beginning date before the Secure Act went into effect, so up until December 31st, 2019, the required beginning date is the April 1st following the calendar year in which the participant attains age 70 and a half, or if they terminate employment later than that, the April 1st following the year in which they've terminated employment after having reached age 70 and a half. And then there's special rules for 5% owners of the company maintaining the plan. After the Secure Act, and this was a significant change by the Secure Act, the age trigger changes to age 72. So for participants who attain age 72 in 2020 or later, their required beginning date is the April 1st following the calendar year in which they've attained age 72. But for someone who attained age 70 and a half in 2019 or earlier, their required beginning date is still the April 1st following the year in which they attained 70 and a half. So this is sort of the cutoff. This is the pivot year. And just a quick note on this, after that first year, the April 1st is really sort of a grace period for the first required minimum distribution, because it's actually paid the year after that it sort of is attributable to. But after that, every year, if the payments are being made in periodic payments as opposed to a lump sum, then they must be made by December 31st of that year. And so conceivably, in the year in which a participant receives his first required minimum distribution, he may also have to get a second one by December 31st of that year. And that's just something to keep in mind for the CARES Act waiver, where the RMDs for 2020 have been waived, because conceivably someone can waive quite a large payment in 2020. And generally, the required minimum distributions must either be entirely paid on the required beginning date, or periodic payments must begin. But a defined contribution plan may require the participant to receive a single lump sum, which is easier for plans. And one thing to keep in mind, because there's a little bit of a change with the Secure Act and the way this works out, is under the current rules, before the Secure Act, before January 1st, 2020, if someone began their payments, they had to be distributed over a period no longer than their life or the life expectancies of the participant and the designated beneficiary. And another important thing to keep in mind about pre-Secure Act laws, that designated beneficiaries are individuals designated by a participant as a beneficiary. And that continues to be true, but the Secure Act added another category. So prior to the Secure Act, so if someone died prior to 2020, this is moving before we talked about what happens if someone is still alive and they hit their required beginning date. If someone dies after their required beginning date and after RMDs have begun, and this is if they've died prior to 2020, the basic rule is that the remaining accounts must be paid to the beneficiary as rapidly as under the method being used prior to the participant's death. And if it's not being paid as an annuity, the longest amount it can be paid over is the remaining life expectancy of the designated beneficiary or deceased participant, their life expectancy having been determined during the year prior to their death. If the death occurs prior to the required beginning date and before required minimum distributions have begun, then generally, if the beneficiary is not the surviving spouse, the payments have to be completed no later than the end of the year following the participant's death, or by the December 31st of the year containing the 5th anniversary of the participant's death, and the beneficiary gets to make that election. If the sole beneficiary is the surviving spouse, the spouse may delay payment until the year the participant would have reached age 70 and a half. After 2020, or beginning in 2020, if a participant, this is a significant change. These are where the rules really changed under the Secure Act. Under the Secure Act, and I must say that these changes only apply to post-death required minimum distributions from defined contribution plans, not defined benefit plans. But the big change is that whether or not the payments have begun prior to death is no longer determinative of the RMD timing requirements. And the other significant change by the Secure Act that affects timing is that it created a new category of eligible designated beneficiaries, who are designated beneficiaries who are either a surviving spouse, a child under the age of majority, a disabled or chronically ill individual, or any person no more than 10 years or younger than the participant. So the way that plays out is if a participant dies in 2020 or later, the basic rule is that a designated beneficiary, and that's one who's an individual who's designated but is not one of these eligible designated beneficiaries, that designated beneficiary must receive full distribution within 10 years of the participant's death. There's no more of the sort of stretching over life expectancies. With respect to eligible designated beneficiaries, the distribution must begin within 1 year of the participant's death and be paid over a period no longer than the beneficiaries' life expectancy. So for eligible designated beneficiaries, it's not quite as different from what was in effect prior to the Secure Act. And just as an aside, if the eligible designated beneficiary is a child, once they reach majority, the payments can only go for 10 more years. It doesn't go for their entire life expectancy. Similar to the pre-Secure Act rules, if the sole beneficiary is a surviving spouse, they may defer distribution until the participant would have attained age 72, which you'll recall is the new age trigger under the Secure Act. But with respect to all other beneficiaries, such as estates and trusts, they must receive full distribution within 5 years of the participant's death. So that takes care of the Secure Act changes, a very broad overview. The other significant change to required minimum distribution rules is that the CARES Act added the ability to waive required minimum distributions in 2020. And that's under Code Section 401A9I, and the IRS issued guidance in 2020, in Notice 2020-51. And I'll talk about this later, but that notice is very useful. It includes a model amendment that the IRS issued, and it also has lots of questions and answers if you have very specific questions about specific situations. But again, this only applies to defined contribution plans, including 401k, 403b, and 457b plans, but it does not apply to defined benefit plans. And it applies to both participants and beneficiaries, but plans are not required to allow participants to waive the required minimum distributions in 2020, but we think most probably have or will. So the basic rule for the waiver is that there's sort of three categories. One is if someone turned age 70 and a half in 2019, or they terminated employment after being age 70 and a half, and their required beginning date was April 1st, 2020, and they had not yet received their payment in 2019, they can waive their required minimum distribution. In addition, any payments that otherwise would have been payable in 2020. So you'll recall that I had talked, subsequent payments need to be made by December 31st of later years. For those people, they can also waive the required minimum distributions. And then finally, anyone who turns age 72 or otherwise would have a required beginning date of April 1st, 2021, they also can waive the amounts. And just something to keep in mind, and this is something for future reference, I think more than anything, the waiver doesn't actually change the required beginning date. It only affects whether payments must be made in 2020. And it also doesn't really affect timing, other than the fact that you don't need to receive them in 2020. But for payments that are subject to the 5-year rule, that are particularly from the earlier rules that were being paid out, say 5 years, within 5 years of someone's death, it essentially, if they're being paid out over 5 years, it's as if 2020 didn't happen. And so people essentially get 6 years. So in terms of the 2020 waivers, it has an effect on rollovers, because even if a plan doesn't allow a participant to waive the required minimum distribution, but the participant got the required minimum distribution, and even depending on how the plan handles it, the amounts that would have been required minimum distributions, but for the CARES Act waiver, may be rolled over into other plans or IRAs. But there's special rules about these rollovers. The plans basically do not necessarily need to treat them like eligible rollover distributions, and therefore they're not required to permit a direct rollover. I mean, they're not required to permit it. They may, but they don't have to require it. And if they're not directly rolled over, the distribution is not subject to the usual 20% mandatory withholding rules, and the employer does not need to give the 402F rollover notice. And also, there's a special rule that's just for these CARES Act waivers, which says that if an RMD is sort of embedded within a periodic payment, it is eligible for rollover, even along with the rest of the payment, even though it normally wouldn't have been eligible for rollover. And then for people who got their distribution earlier this year and then realized that they didn't have to have taken it, the IRS in that notice gave an additional amount of time for them to make to do the rollover. Normally there's a 60-day period during which people need to make a rollover, but people had through August 31st, 2020, even if that would have meant that they waited more than 60 days. But now we're back to the 60-day requirement. So quickly, I'll mention that the plan amendments, if a plan does require, or if a plan does permit waivers of the required minimum distribution amounts, it will need to be amended by the end of the 2022 plan year, if it's a calendar year, as Rebecca mentioned. And the IRS provides a model amendment that gives different options that the employer can use. And because I need to still talk about safe harbor 401k plans, I'm not going to go over the details of the amendment, but it does give the employer the ability to choose which sort of default it's going to use. If a participant or beneficiary does not make an election about whether they want to receive a distribution or not, then the plan can decide whether it's going to push out what would otherwise have been the required minimum distribution or not pay it. So that's one thing that would be in the amendment. And then the other thing, the amendment has, the model amendment allows the employer to choose which amounts, if any, they're going to allow to be directly rolled over to other plans. And employers do not need to use the model amendment, but it does protect against possible violation of the code section 411D6 anti-cutback rule. So it's probably good to do that, because otherwise, if you, for example, don't give people their required minimum distributions and then you amended your plan, that might be considered a cutback. So it's better to use the IRS model amendment. Okay, moving now to matching and non-elective contributions under 401k safe harbor plans. As many of you probably know, this year, many people wanted to stop or reduce their matching or non-elective contributions to the safe harbor 401k plans. I'm going to talk a little bit about, mostly I'm going to talk about what can be done in the future, because even though the IRS provided relief, as you may or may not know, and I'll give a little details about that, most of that relief period is over, and so we just need to look forward in case you might want to do that in the coming year. So, as many of you probably also know, the advantage of being a safe harbor 401k plan is that the employer does not need to run the actual deferral percentage tests, and if there's matching contributions, the actual contribution percentage tests. And that eases the administration of the plan, and that's a positive for most employers. In order to get that advantage, though, the employer must make a specified level of matching contributions or a specified level of non-elective contributions to the plan, and the plan must satisfy certain vesting requirements. And also, in many cases, the employer must provide a safe harbor notice before the beginning of the plan year describing the safe harbor features. It used to be that that was required for all safe harbor plans, but now, beginning in 2020, under the Secure Act, that pre-plan year safe harbor notice is optional for plans that use the non-elective contributions to satisfy the safe harbor. One thing to keep in mind, though, and I'll talk about this later, is that all plans probably want to provide that notice before the beginning of the plan year, because providing it and including certain information in it will preserve your ability to make changes to those contributions in the middle of the plan year. So I think we already talked about this, but in Notice 2020-52, the IRS temporarily waived some of the restrictions on suspending or reducing safe harbor and matching contributions and non-elective contributions. But realistically, that relief isn't really available anymore, because generally speaking, the amendment for that had to be adopted by August 30, 2020, and the supplemental notice that needs to be given to participants also had to be given no later than August 31st, 2020. And under the IRS notice, there's easier rules for stopping or suspending the matching or non-elective contributions on behalf of only the highly compensated employees. So if you think it's worth it for this small period in the remainder of the year, that might be something that could be done. And there's special rules for the highly compensated employees that are set out in IRS Notice 2020-52. But realistically, probably the better thing is to look forward to next year and just make sure that you preserve your ability to make changes in the year. And so first I'll talk about IRS regulations that have been in effect for a while, and I presume will continue to be in effect, and explain what you'll need to do to satisfy those requirements if you think you might want to reduce or suspend the matching contributions or non-elective contributions next year. The principal requirement is that the plan sponsor must be operating at an economic loss for the plan year, or the safe harbor notice that is provided to the participants prior to the beginning of the plan year has to have included a statement that says, 1, that the plan may be amended during the plan year to reduce or suspend the safe harbor contributions, and 2, that the reduction or suspension will not apply until at least 30 days after all eligible employees receive a supplemental notice of the reduction or suspension. And this is a very important requirement because the first one can be difficult to prove. There's very little guidance about what it means to be operating at an economic loss. And that, in fact, was one of the requirements that the IRS waived earlier this year when they gave the special relief. But going forward, you'll either need to satisfy that one or have provided a safe harbor notice that preserves your ability to make changes during the following plan year. So the theme of this part of this talk is that you're going to want to give that notice to participants before the beginning of the plan year and include this statement. And you'll want to do that even if you haven't a safe harbor plan that uses non-elective contributions as the way you meet the safe harbor requirements, because that way you have the ability to change them during the plan year. But moving ahead, no matter what though, you'll still need to satisfy these other requirements, so it's good to keep those in mind too. If in the middle of the plan year you decide you want to suspend or reduce the matching or non-elective contributions, even if you've given that notice prior to the beginning of the plan year, you will also need to adopt a plan amendment prior to the effective date of the change. The plan has to satisfy the safe harbor requirements for that part of the plan year that occurs prior to the effective date. The plan amendment must provide that the plan will satisfy the ADP and ACP non-discrimination test for the entire year, and you have to give the eligible employees a supplemental notice about the change at least 30 days prior to the amendment effective date. Finally, you need to give the eligible employees a reasonable amount of time in advance of the effective date to change their elections. So basically what it all comes down to is, if you want to be able to preserve your right to reduce or suspend matching contributions or non-elective contributions, when you give your pre-plan your safe harbor notice this year, which you should do even if you're not required to because you are using non-elective contributions, you should include in the notice the statement that the plan may be amended during the plan year to reduce or suspend the safe harbor contributions, and you have to give and you have to also include the statement that the reduction or suspension will not apply until at least 30 days after all eligible employees receive a supplemental notice about the reduction or suspension. And if you do that, you'll have preserved your ability. So with that, I think I'm done, and I will turn it over to Hillary August, who will talk to you about updates at the Department of Labor.
So today, Maureen and I will be discussing updates under Title I of ERISA, and specifically, the DOL has published a number of new proposed and final regulations lately that we'll cover, including final regulations on electronic disclosures of retirement plan notices, proposed regulations on ESG investing, proxy voting, and the registration process for pooled plan providers of pooled employer plans, and the DOL's interim final rule on lifetime income disclosures. And we'll conclude with a discussion of recent litigation developments. First, the electronic disclosure rule, which was published in the Federal Register on May 27th and came into effect on July 27th of this year. And these new regs govern the electronic distribution of retirement plan notices, not welfare plan notices. So to back up, in 2002, the DOL initially issued regulations regarding the distribution of electronic disclosure plan notices. And the main features of those regulations was that a plan administrator could provide notices about an ERISA plan electronically to two classes of people. And the first were people who were wired at work, which were people who had the ability to access their computer at work and for whom using work email was an essential part of their duties. And second were people who affirmatively opted in to receiving e-disclosures. So these were opt-in rules. And the regulations were updated somewhat in the intervening years, but there was never a wholesale update to take into account what were really the massive changes in the way that we use electronic communication between 2002 to the present. So in the fall of 2019, the DOL published proposed e-disclosure regulations, which came into force this spring. And the regs cover retirement plan notices, like I said, not welfare plan notices, and have two main features. First, they have an opt-out structure as opposed to an opt-in structure, like under the 2002 regulations. So plan administrators can send e-disclosures of retirement plan notices unless people affirmatively opt out of receiving them. Second, the regs establish two safe harbors for providing electronic notice. Notice of an e-disclosure can be provided through a notice and access safe harbor, by which the administrator would notify participants of an ERISA disclosure has been posted online. Or second, a plan administrator can email a disclosure directly to participants. Under the regulations, a covered document that can be sent electronically is essentially any document that's required under Title I of ERISA. So this would include documents like summary plan descriptions, summaries of material modifications, fee disclosures, and benefit statements. What's not covered would be a document that is only furnished upon request, or documents that have to be provided to participants due to provisions in the Internal Revenue Code. For example, if you have to provide notification to participants of certain IRS filings, you cannot take advantage of the new regulations to distribute the filing. Who can receive these new disclosures would be a covered individual. And a covered individual is defined broadly as any participant, beneficiary, or any other individual who provided an electronic address. And when I say electronic address, if we're talking about people who, if we're talking about plan administrators who chose the notice and access safe harbor, an electronic address includes a smartphone number. Additionally, anyone who receives an employer-assigned electronic address is a covered individual who can receive electronic disclosures so long as that electronic address is used for purposes other than just sending retirement plan notices. In order to use the new regulations, a plan administrator must send every plan participant who is going to be covered by the new regulations an initial paper notice of the future e-disclosures. So this is true even if a participant was already someone who was wired at work or was otherwise receiving electronic disclosures under the 2002 safe harbor. Among other requirements, this initial paper notice must list the email address that the plan administrator will use to send out future e-disclosures, and it has to contain instructions on opting out of receiving electronic disclosures entirely and only receiving paper disclosures. After the first notice, the plan administrator can begin sending out electronic notifications, but each subsequent electronic notification has to again contain instructions on opting out entirely, and it also has to notify a recipient of the right to receive a copy of the electronic notice free of charge, although the DOL made clear that it wouldn't allow a la carte opt-out. So for example, a participant couldn't say, well, I only want to receive SPDs electronically and I want to receive everything else in paper. That's not the way it works. A covered individual could request one specific document electronically, but could not request a class of documents electronically and a different class by paper. The regs are designed to ensure that plan administrators are monitoring to ensure that people are actually receiving electronic notices, because one of the main purposes behind the regs was to ease access to retirement plan notices. So if an administrator learns that, for example, emails from a certain participant are bouncing back, the administrator has to either go out and get a new electronic address from that participant or start sending notices on paper. And when a participant terminates employment, the administrator has to ensure that they still have a valid email address for that person. As I said earlier, the new regs create two safe harbors, and the first is a notice and access approach. Under that approach, a plan administrator would send out an email to inform participants that a covered document has been posted on a website, and the email has to contain the web address or a link to take them to that website. And this notification has to be electronic. It could not be sent in paper version. And the notice on the website has to be searchable and generally as easy to read as any paper notice would be. The second option is the direct email route. In that case, the covered document could either be in the body of an email or it could be sent as an attachment. And because a covered document is being sent directly, an administrator would not have to maintain a website or send a separate notice of internet availability. Some key considerations in deciding whether and how to use the new safe harbor are, first, as I mentioned, the new safe harbor only applies to retirement plan notices, not welfare plan notices. So it's very possible that plan administrators already have a system in place to send both retirement and welfare plan notices electronically under the 2002 safe harbor, and that would not be possible under the new safe harbor. The DOL did say that it was considering the use of the electronic disclosure rule for welfare plan notices, but it has not adopted that yet. Another issue to keep in mind, of course, is that the plan administrator has a fiduciary obligation in selecting and monitoring any third-party company that sends out e-disclosures and maintains a website. Another question is whether to use the notice and access safe harbor and post cover documents on a website or to use the direct email safe harbor. And generally, we'd say if you're a small employer that doesn't already have an employee intranet, it might be easier to send out the emails with the documents directly. On the other hand, if your workforce is used to going to an online repository for key documents, a website makes more sense. And if you are going to go to the notice and access route, the DOL suggested that an app, a mobile application, would suffice as the website, but didn't really provide additional instructions on building the app or user requirements for the app. And so we think you'd want to be very careful if you decide to use an app and keep in mind the relative electronic savviness of your workforce to ensure that people can access the documents in light of the fact, again, that the regulations were intended to ease access to retirement plan notifications. You'd also want to think about whether to adopt the new safe harbor wholesale or continue with the 2002 safe harbor. If you have someone who's already receiving e-disclosures, it might be confusing for them to receive a paper notice saying that they're going to receive electronic disclosures in the future. But under the regs, you could continue to use the 2002 safe harbor for participants who are already covered by that safe harbor, and then use the new safe harbor for people who were not covered by the 2002 safe harbor, either because they're new to a company or because they weren't wired at work or hadn't opted in. Next, I'll discuss the DOL ESG Proposed Rule, which the DOL issued on June 23rd. And ESG factors are environmental, social, and governance factors, and factors that may apply in selecting investments for ERISA plans. The background of the reg is that ESG investments have actually surged in popularity recently, but the other side of the coin is the political side. Generally, in Democratic administrations, the DOL is more permissive in its approach to ESG investing, whereas in Republican administrations, less so. So the DOL's proposed rule on ESG investing would amend the investment duties regulation to provide that fiduciaries can meet their duties of loyalty and prudence under ERISA if they evaluate investments based solely on pecuniary factors. And a pecuniary factor under the proposed rule is one that has a material effect on the risk and/or return of an investment based on appropriate investment horizons consistent with the plan's investment objectives and funding policy. The rule also has documentation obligations and rules related to QDIAs. The proposed rule is fairly broad in its usage of the term ESG-themed investments. An ESG-themed investment is one that includes one or more environmental, social, corporate governance, or similarly oriented assessment or judgment in their investment mandates, or that include these parameters in the fund name. In the preamble to the proposed rule, the DOL emphasized its concern that ERISA fiduciaries may be making investment decisions for purposes other than solely providing financial benefits to participants and beneficiaries and defraying reasonable expenses. And in essence, that they're pushing their own agendas through retirement plan investments. But the DOL noted that fees associated with ESG funds may actually be higher because ESG funds require additional investigation and monitoring. And the DOL is also generally skeptical of the ESG fund, as it expressed in the preamble to the regs, since there's no consensus on what constitutes a genuine ESG investment. And above all, the DOL wanted to emphasize that ERISA's duty of loyalty requires fiduciaries to act with a single-minded focus on the interest of beneficiaries, and the duty of prudence prevents a fiduciary from choosing an investment alternative that's financially less beneficial than an available alternative. Under the proposed rules, fiduciaries can only evaluate investments based on pecuniary factors. The rule recognizes that fiduciaries may consider ESG factors as pecuniary factors in certain situations. So the DOL gave two examples of this. The first is where a company's improper waste disposal could pose a threat of additional liabilities or regulatory risk or litigation. And the second is where a company has a dysfunctional improper governance. So in both of these cases, even though those are ESG factors, it's clear how they could impact an investment's value. And another time when it may be proper to consider ESG factors is where two investments are otherwise economically indistinguishable. If a fiduciary is considering ESG factors in the case of this tie situation, which the DOL did recognize is going to be a rare situation, the fiduciary would need to document its reasons for selecting the ESG investment. And if an ESG-themed investment is selected, again, a fiduciary would have to base its decision on objective risk-return criteria and document its reasons. And finally, ESG investments cannot be added as or as a component of a QDIA. Some key considerations for the ESG proposed rule. First, it was proposed in June and the comment period extended through July, but much of the feedback that the DOL received about the rule was negative. I saw a study saying around 95% of commenters disfavored at least some aspect of it. So it may change before coming into force, but if and when it does, potential considerations include the level of documentation that will be required of fiduciaries if they do decide to adopt an ESG-themed investment for a retirement plan. And fiduciaries should be thinking about any processes they may want to implement for reviewing ESG investments as compared to alternatives, and any associated administrative burden. And finally, weighing the potential pecuniary benefit of an ESG-themed investment versus the potential risks of including them. For example, it's possible that increased scrutiny on investment options may lead to an uptick in litigation regarding ESG investments. The DOL published another proposed rule in the Federal Register last month regarding proxy voting and the exercise of shareholder rights. And the comment period for this rule finished just last week. Like the ESG proposed rule, it would also amend the investment duties regulation and also goes to the same DOL's theme of ensuring that, that fiduciaries are acting in the best interest of plan participants. So under the proposed regulation, a fiduciary must vote proxies where the matter being voted upon would have an economic impact on the plan, taking into account the cost of voting. Conversely, a fiduciary may not vote proxies if the matter would not have an economic impact on the plan. The DOL stated that the new rule, the proposed rule, is intended to clarify what it said is a misunderstanding among plan fiduciaries who think that they have to vote all proxies, and the DOL wanted to make clear that that is not the case. And the DOL also said in the preamble to the proposed rule that it wanted to rescind guidance issued under the Obama administration, which did not require fiduciaries to consider whether the plan's individual exercise of its voting rights would affect the value of the plan's investment, but instead whether the votes of all the shareholders would affect the value of the plan's shares. And like the ESG guidance, the proposed rule makes clear that proxy votes may not be used for any purpose other than enhancing the value of the plan's investments. Under the proposed proxy voting rule, a fiduciary must act solely in accordance with the plan's economic interest by considering only factors that affect the investment over an appropriate time horizon. A fiduciary must also consider the impact of any proxy vote on the plan's investment performance based on factors such as the size of the plan's holding in the issuer relative to the total investment assets of the plan and the plan's percentage ownership of the issuer. A fiduciary may not subordinate the interests of the participants and beneficiaries to any non-pecuniary objective or sacrifice return to promote goals unrelated to financial interests of the participants. So that harkens back to the language of the ESG proposal. A fiduciary must also investigate the material facts forming the basis of any proxy vote, and it cannot simply adopt a practice of following the recommendations of a proxy advisory firm without appropriate supervision of that firm and a determination that the firm's practices are in line with the participants' best interests. The proposed regulation also imposes a requirement that fiduciaries maintain records on proxy voting activities and other exercises of shareholder rights, including records that are sufficient to demonstrate the basis for their decision to vote any proxy. And finally, a fiduciary has to exercise prudence and diligence in selecting and monitoring any third party that advises on proxy voting. The DOL also proposed that in deciding whether to vote proxies, a plan may adopt a proxy voting policy, and the policy may include 3 non-exclusive permitted practices. These are not safe harbors, although the DOL did endorse them as permitted practices. One would be voting proxies in accordance with management recommendations on proposals the fiduciary has determined are unlikely to have a significant impact on the value of a plan's investment unless the fiduciary has a reason to believe that management's recommendations may be conflicted. A second would be a policy that voting resources will only focus on particular types of proposals that are substantially related to the corporation's business, such as proposals related to corporate events like mergers and acquisitions. And third, a policy that a fiduciary will refrain from voting on proposals where the plan's holding relative to the plan's total assets is below a certain threshold, such that the outcome of the vote is unlikely to have a material impact on the plan's investment performance. Some things to think about in advance of the rule being finalized, and especially it's important to prepare because under the language of the proposed rule, the rule would actually come into effect as soon as 30 days after publication in the Federal Register. First is whether fiduciaries should establish a proxy voting policy, and if a policy is established, it would have to be reviewed every 2 years and would have to be provided to participants upon request. Second, even though rules say that fiduciaries have to sufficiently document their reasons for choosing to vote a particular proxy or how to vote the proxy, it doesn't really specify the level of research or documentation needed. So fiduciaries should ensure that plan records contain adequate information about any research conducted and the reasons for coming to a particular decision. Third, to the extent that fiduciaries use a proxy voting firm or another advisor to assist in voting proxies, there is again a fiduciary duty to prudently select and monitor that firm. And the fiduciary must also ensure the firm is keeping its own adequate records of any voting decisions. And finally, a last thing to keep in mind is the proposed rule does not cover the voting of shares inside mutual funds. So now I'll turn it over to Maureen to continue with the DOL updates.
Thanks, Hillary. I'm going to start with new developments in the lifetime income disclosure area. And on September 18th, 2020, DOL issued an interim final rule that sets forth the elements for meeting those new disclosure requirements that were created by the Secure Act. Just by way of background, as I think probably our audience knows, under ERISA Section 105, plan administrators of defined contribution plans are required to provide benefit statements at least annually, and in the case of a plan with participant-directed investments, has to provide those statements quarterly. The Secure Act created a new requirement that plan administrators of defined contribution plans include in their benefit statement lifetime income disclosure, and what that means is the disclosure which has to be provided at least annually, has to set forth the amount of a QJSA and a single life annuity that are each actuarially equivalent to the participant's total account balance. And the lifetime income streams are to be calculated in accordance with assumptions issued by the DOL. The Secure Act tasked the DOL with issuing an interim final rule, the assumptions for doing the conversion, and a model disclosure by December 2020, with the idea that then a year after that, benefit statements issued would begin to have to comply with the new lifetime income disclosure requirements. Because the DOL issued the rules and met all three requirements in September of 2020, that means benefit statements after September 18th of 2021 will now begin to have to meet those requirements. So I think we're going to see a lot of gearing up on the part of vendors and record keepers to help employers and plan administrators meet those requirements. Now, you might think that employers would have some nervousness about going out there with this kind of disclosure, given all the ERISA litigation and the really explosion of ERISA litigation. Employers might be nervous that if they gave employees a projection, the types of annuities they could fund with their account balances, that years later, when employees weren't able to do that, they might come back and sue the employer. Congress anticipated this and included or added to Section 105 of ERISA a limitation of liability. And it provides in pertinent part, and I've quoted it here, that no plan fiduciary or plan sponsor will have liability solely by reason of providing this information, as long as, and this is critically important, they use the assumptions prescribed by the DOL and include explanations that are to be included in the model to be provided by DOL of how those numbers are calculated. I've included here a picture on this slide of the way the numbers might be disclosed to participants, and this is directly from the new DOL interim final rule. And you can see on the left the amount of the account balance, in the middle the monthly payment under a single life annuity, and in the far right the monthly payment under a QJSA. And again, each of those annuities are supposed to be actuarially equivalent to the account balance. The statement is to show the account balance as the last day of the statement period. So what assumptions did DOL prescribe that plan administrators use when coming up with these actuarially equivalent annuities? And I've reproduced them here on slide 57. It's kind of interesting to just consider why the DOL did what it did. First of all, when the annuities are calculated, you're supposed to assume that payment will commence on the last day of the period covered by the statement, and at that date the participant is age 67, or the participant's actual age is if they're older. So what the DOL is saying is we're supposed to show someone, if they took their current account balance today, converted it to an immediate annuity, and they were age 67, this is the monthly benefit they could get under either a single life annuity or a joint and survivor annuity. For purposes of the joint and survivor annuity, we're to assume that the participant's married and that the spouse is the same age as the participant. The interest rate assumed is to be the rate equal to 10-year constant maturity Treasury securities. Now, that's a very low rate, and you might ask, why did the DOL pick that? And the reasoning seems to be that they had a lot of comments from the insurance industry that this interest rate is probably pretty close to the interest rates used in calculating annuity purchase rates. So it gives participants some idea of what they could purchase if they took their account balance and went on the market and tried an annuity. The mortality table, as you might expect, is the 417E table. And in doing the calculation, you assume the participant's 100% vested in their account, that there's no insurance load and no inflation adjustment. Perhaps most critically, the new benefit statements have to include brief but understandable explanations of the assumptions underlying those illustrations. And the primary purpose seems to be to make sure that participants understand that these are not guaranteed lifetime income streams. These are projections based on assumptions that probably will not be, almost certainly will not be perfectly realized. The interim final rule also includes model language, and you don't have to use that model language. You can come up with your own explanations, but if you don't use the model language, you don't get the relief from liability that I talked about a little bit earlier. There's some flexibility in format that's permitted. You can use the consolidated model DOL as provided, or you can break it up and insert different paragraphs at different points of your existing benefit statements. Now, some defined contribution plans provide for distribution annuities, meaning the plan administrator has entered into a group annuity contract insurance company, and when participants terminate, their account balance can be turned into an annuity under that contract. And where that's the case, where there's an annuity offered through a contract with a licensed insurance company, the disclosure should be based on the terms of that contract, not the mandatory assumptions set forth in the IFR. I shouldn't say should, the plan administrator may base the income disclosure on the terms of the contract. You still have to show the single life annuity and the qualified joint and survivor annuity commencing on the last day of the statement period and assume the person's 67, but otherwise you can use the terms of the contract. Another real interesting product that some defined contribution plans are incorporated are deferred income annuities. And the way those annuities work is as the participant makes contributions to the plan, they can direct that some of their money go into literally locking in an annuity that will provide for payment at a later date, for example, when the participant retires, or in some cases even later at something like age 85. So you're buying the annuity now, but commencement begins years and years later. And as the contributions are used to purchase the annuity, the purchase reflects the current interest rate environment and the participant's age at the time of purchase. If you have that sort of an deferred income annuity embedded in your plan, the IFR contains special disclosure rules, and essentially what you tell people is the actual payments they're entitled to and when they commence and so forth, because these payments are not projected based on assumptions. They're actual payments that the participant has already purchased. But there's no model for this disclosure, and according to the DOL, the relief from liability rule does not apply, so just bear that in mind. I'm going to turn to pooled employer plans at this point. The Secure Act created pooled employer plans to remove the barriers to the broader use of multiple employer plans by small and medium-sized employers. And the goal of the change was to make it simpler and more cost-effective for small employers to sponsor qualified plans. The DOL in September, just this past month, issued proposed regulations describing the registration process for pooled plan providers, and those are, and we use the acronym PPP to describe them, those are the entities that would sponsor pooled employer plans. They're required to register electronically before beginning their operations. Now, you might ask, why did we need another retirement vehicle? And the answer can be found, I think, in some of the historic DOL and IRS positions on multiple employer plans. The DOL position historically has been that if multiple unrelated employers share a common interest, either through industry or geography, they could band together in a what was called a closed multiple employer plan for purposes of satisfying many of ERISA's requirements, such as the annual 5,500 requirement. But if a plan of unrelated participating employers that didn't share a common nexus participated in a multiple employer plan, they were each treated as single employer plans and had to separately satisfy the ERISA reporting and disclosure requirements. DOL also took the position that banks and insurance companies and other financial firms couldn't act as multiple employer plans that were intended to be treated as a single plan. Further, the historic IRS position would if even one of those employers didn't meet the qualification requirements, the whole multiple employer plan was bad. That was called the one bad apple rule. The Secure Act essentially reversed those historic DOL and IRS positions and created this new retirement vehicle called a pooled employer plan. Unrelated employers can participate without that common nexus, and it'll still be treated as a single plan for purposes of the ERISA reporting and disclosure requirements. Further, the arrangement can be sponsored by a bank or insurance company or other financial firm that's unrelated to the employers. And so there's a good deal of excitement in the market among these entities about possibly maintaining these vehicles. The Act also reverses the old one bad apple rule. The fact that a single employer fails to satisfy the qualification rules won't devastate these plans as long as the PEP provides for the transfer of the offending employer plan to those assets to another specified arrangement. A PEP can be either a defined contribution plan or a group of individual retirement accounts. And this slide describes the requirements applicable to those programs. Just on account of time, I won't go through it all. The most important point here may be the link to the Mayor Brown article at the end. We have published this, and it goes through FAQs on the requirements. But I'll just mention one very salient requirement, which is that the PPP has to be registered with the DOL, and it must be designated by the PEP as the named fiduciary and the plan administrator. The benefits that are touted for PEPs is that because it's treated as a single plan for all the ERISA reporting and disclosure requirements, it streamlines administration, results in lower costs for employers. Also, the pooling of assets perhaps and the attendant economies of scale may make the plan able to obtain less expensive investment options, and it reduces the fiduciary burdens on the employer because a good deal of it is transferred to the PPP. There's some complicated questions about possible conflicts of interest on the PPP if they're using affiliates and bundled services and proprietary funds. We won't go there today, but just watch out for that. I'm going to turn to litigation in this area, and as I mentioned before, there's been an explosion of litigation in the ERISA area in the last several years. We're going to focus on two areas of litigation today where there's been quite a bit of recent activity. One are what I call the actuarial assumption cases, and the other are cases involving single employer stock funds. In the area of actuarial assumptions, since late 2018, 11 cases have been filed challenging the actuarial assumptions or conversion factors used in defined benefit plans. And the suits usually allege one of the following. First, if you have a plan that has the single life annuity as the normal form and it's converted to a joint and survivor annuity or another form of annuity using assumptions that the plaintiffs object to or tabular factors they think are unreasonable, they will allege that those assumptions and so forth violate the actuarial equivalent requirement of ERISA. The second category of cases will allege that certain assumptions applicable for purposes of reducing a benefit to reflect early commencement are unreasonable and result in a benefit that isn't actuarially equivalent to the participant's accrued benefit at normal retirement. And plaintiffs' claims are typically brought under ERISA Section 203, 204, or 205. ERISA Section 203 provides that a benefit has to be non-forfeitable upon attainment of normal retirement age. 204C3 says if a participant commences payment at a time or in a form other than at normal retirement age, the accrued benefit has to be the actuarial equivalent of that normal benefit at normal retirement age. And 205 requires that the QJSA be actuarially equivalent to the normal form. Now you might say, well, what's meant by actuarially equivalent? And that, frankly, is still the subject of litigation, but a definition suggested by one court that's intuitively attractive to me is that it simply means that two modes of payment are actuarially equivalent when their present values are equal under a given set of assumptions. Calculating the present value of a stream of payments, of course, requires that you know the dollar amount of the payment, the length of time over which it will be made, and the appropriate discount rate. Mortality tables are generally used to figure out the period over which an annuity is paid. So for the factor how long will the payment stream last, you use a mortality table. In cases that allege that the assumptions for converting a single life annuity to a different kind of annuity are unreasonable, the challenge is generally aimed at the use of the mortality table that the plaintiffs claim are outdated. And the reason for this is because an older mortality table in general will produce a lower benefit than a more recent mortality table that reflects longer life expectancies. And the tables challenged have ranged from tables issued in 1951 to 1984. Interestingly, the plans that use the old mortality tables also typically specify a higher rate of interest for purposes of conversion rather than the more modern interest rates that are lower. And so the interest rate works opposite the mortality table. The higher the interest rate, actually, the better the JNS. So older mortality tables and higher interest rates tend to offset each other. And an argument in these cases is, well, we may be using old assumptions, but together in combination, they actually produce a benefit that's as favorable as if we use more modern assumptions. Just on account of time, I'm going to click forward a little bit and go to the results in the cases. In 3 cases, motions to dismiss have been granted, but as I say to clients, don't pop the champagne corks because they were dismissed for reasons that aren't that helpful. For example, in Brown v. UPS, the court granted the motion to dismiss because plaintiffs hadn't exhausted their administrative remedies. In Pepsi, the plaintiffs really hadn't claimed an injury. I won't try to explain it here, but the slides do go into it. And in AT&T, the court granted the motion to dismiss again because plaintiffs hadn't suffered an injury and they lacked standing. They were actually wrong when they claimed that inappropriate factors had been applied to their benefits. In the following 7 cases, the courts have denied the motion to dismiss, and there's a lot of statements in those cases that are pretty troubling. But we are at the motion to dismiss stage. There hasn't been a decision on the merits, and so that's somewhat comforting, but we really have to watch these cases carefully. I wanted to just talk very briefly about the Herndon case. In addition to denying the defendant's motion to dismiss, in Herndon, the court denied the defendant's motion for summary judgment. That case challenged a 6% interest rate and a 1971 GAM table, which the plaintiff claimed were outdated and unreasonable and produced a benefit that was not actuarial equivalent to the normal form. And it's interesting, the plaintiff's expert focused on that 1971 table and said that input is unreasonable and violates the ERISA's actuarial equivalent requirement. The defendant's expert focused on the fact that that interest rate, which was higher, 6%, and the old table together produced results that he said were within a range of reasonableness. They were very close to what modern assumptions would produce. The magistrate identified this as a central issue of the case. He said, whether actuarial equivalence is gauged by assessing the reasonableness of the inputs versus the results is a central issue of the case, and it's something for the fact finder. And so he recommended against summary judgment, and the court went along with that and denied summary judgment. I just want to take a minute on single stock fund cases. There were 2 cases that came out in 2020, Gannett and Schweitzer, that each deal with the way fiduciary duties apply to single stock funds. Single stock funds result when you have a corporate spinoff and stock in a subsidiary gets distributed to shareholders, and let's say one of the shareholders holds parent stock. These cases have been brought because participants challenged the inclusion of a single stock fund after a spinoff. Post-spinoff, the single stock fund is no longer an employer security if the subsidiary is no longer in the parent's controlled group. That parent stock ceases to be an employer security, and the significance of that is that that stock is not exempt from the diversification rules. Gannett and Schweitzer analyzed the duties of prudence and diversification differently, and also whether or not participant choice can be alleged as a defense at the motion to dismiss stage. And just summarizing very briefly, Gannett took the position that the diversification requirements apply at both the fund level and the plan level, which is going to be a very difficult test for single stock funds since they consist of only one asset. Gannett also rejected the idea that participant choice could be alleged as a defense at this stage and could compel a motion to dismiss because the court said it's an affirmative defense and it's not appropriate to bring it at the motion to dismiss stage. Schweitzer did acknowledge that it can be imprudent to maintain a single stock fund because they're inherently risky, but ultimately granted the motion to dismiss on the grounds that because the funds were frozen, that the fiduciaries weren't offering the investment option, but the court also held as significant the plan participants could divest. They had some choice. And so the Schweitzer court was willing to consider participant choice as a defense at the motion to dismiss stage. With that, I'm going to stop. I think we have time for a couple questions. And this one is for Ceci, and I just want to pull it up. It's from one of our audience members, and she asks, can an eligible designated beneficiary elect to choose the 10-year period?
Okay, thank you for that question. I actually think it's not 100% clear. I think that generally speaking, they could choose that. The question really is, mostly the eligible designated beneficiaries, I think, are assumed to have at least a 10-year life expectancy, because you'll recall that the one of the eligible designated beneficiaries, to be that, you had to be at least no more than, well, I guess it would be the opposite. They couldn't be more than 10 years younger. But in any event, it seems to me that eligible designated beneficiaries are treated a little bit more favorably, so that I think that if they wanted to receive their payments over 10 years rather than choosing life expectancy, they would be allowed to do that. But that's just based on my general sense of the more generous rules that apply to eligible designated beneficiaries. When I was doing research for this, I didn't see anything in the current IRS guidance, at least that I can recall, that addressed that. But I think that when the IRS comes out with regulations, they probably will address that, because that seems like a very basic question. But I don't think there's any guidance on it yet.